We're privileged to be witnessing the early stages of a gold price revaluation, which is an ongoing process, not a single event.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
All right, welcome to Live from the Vault. My name is Shane Moran, and I'm thrilled to be your host for this episode. And from the entire Live from the Vault team around the globe, we extend our heartfelt thanks for your unwavering support. Thank you so much. As you might imagine, this community keeps expanding week by week. It's amazing, and we couldn't be more excited about that. And welcome to our first-time viewers to Live from the Vault. We're in the midst of a historical times right here and today. We've got the one and only Andrew Maguire in the vault, and our very own precious metals expert and whistleblower. And he's here talking gold, so buckle up. This is going to be an incredible episode. And Live from the Vault brings you weekly exclusive insights and updates that you simply won't find anywhere else. And this episode is no exception. But before we dive into talking gold with Andrew Maguire, let's take a moment just for a second here to spread the word about our channel. Please hit that like button, not now, but right now. Share this video, and don't forget to smash that subscribe button if you're not already subscribed. But now if you are subscribed, just make sure you hit that black bell right there, and we'll notify you as each of these episodes goes live. So, all right, hit that like button right now. And without further ado, let's cross over to the UK and some in-depth gold talk with the one and only Andrew Maguire. All right, Andrew, at the open of the first quarter of 2025, gold was priced around $26.50, and you called right there. You called gold. You said it would reach 3,000 by the end of the first quarter of 2025, and I can imagine people were gasping when you said that. But guess what? Q1 and you can see, we've hit it, by the way, and Q1 isn't over yet, but that's awesome. And I know you always expected a fight into the end of each month where billions of dollars of paper market derivative bets get marked to market. And however, as you've said, these end of month price capping events have become opportunities for competing central bank buyers to just fill their golden boots again with more and more. They're buying. Now at 3,000 has been hit. Where do you see gold priced into, let's say, the end of the second quarter, Andy?
Great to be with you again, Shane, and great to be with everybody. You have to excuse me a little bit, Huss, today. I've caught something very nasty. And I don't know what it is, but anyway, running a bit of a fever here. So if I've stumbled a bit, just please excuse me a bit. But you're absolutely right, Shane. What we'll do is we will actually look at these upcoming stair steps into the next three quarters, because that's our job now, is to really use everything that we take, all the pieces that we can see from the wholesale market, especially, and kind of give us a good sense of where we actually should be. And because really what we're seeing is a drain of paper market price setting liquidity, and it is flowing out into the physically settled exchanges. So I'm happy to go out on a limb with price discovery migrating out of this legacy car sales sphere influence. It's getting a lot easier, and that's why 3,000 wasn't hard to figure out. So what I'm saying is this, because of this drain of paper market liquidity into the physical markets, the lines have crossed irreversibly, and we are evidencing a real physical gold price emerging. And as we will see, it's got a long way to go yet. And as we drew attention to in our last episode, which was 2 weeks ago, the gold market bear squeeze is actually gaining momentum. And a look at this last 2 weeks action really does provide us more evidence of the race to short cover ahead of the 1st of July Basel III compliance. It's a big deal. Let's start by looking at the larger picture then. Then we'll look at the end of the quarter footprints. And based on what we are once again seeing in the tight for supply of physical markets, then we'll have some projections for the end of the next three quarters into 2026. It's not about the Fed or tariffs. We're privileged to be witnessing the early stages of a gold price revaluation, which is an ongoing process, not a single event. We're witnessing it. We're privileged to see this historic thing unfold. However, there will be some inflection points, which we will, as we witnessed, and they're bullish ones, as we witnessed when the Shanghai Futures Exchange launched at $2,000 back in March last year. And now a similar bullish driver is the run-up to the 1st of July. And we'll look at that a bit closer in a little while. But all our projections have relied upon where central bank sovereign buy interest is, and it's been steadily stair-stepping higher. It's now become impossible for fund managers to ignore gold, gold has outperformed every single other asset class. And this huge untapped source of investment flows have yet to come into gold, and they're only just waking up to it. And I think Peter Grandage said the average fund manager has maybe 0.5% exposure to gold. That's interesting. So this fresh incoming investment demand into already tight supply indicates 3,000 gold is massively underpriced. So let's take a look at the footprints and where they're ultimately headed and why. And as we summed up in our last episode, into stretched out physical gold delivery timelines, which are delivery defaults by no other name, an increasing percentage of leveraged COMEX paper market gold longs, they're fully paying up their COMEX positions to force physical delivery. Now, we call this the sticky open interest component, which is the fund managers who are buying it for a reason, for the right reasons. But it's also forcing large COMEX outflows into the exchange traded funds, compounded by physical buyers targeting the COMEX backdoor EFP mechanism, the backdoor EFP mechanism, which is the Achilles heel. And because that then forces a non-compliant, a non-Basel III compliant paper price, if it lands in London on a T+1 delivery basis in a compliant market, and what was previously cash settled comes into full physical settlement into this Basel III compliant local London market. Now, look, it's easier to illustrate when we pop in to look at the charts.
Now, I'm recording this just for reference ahead of FOMC tonight. Obviously, you'll have that number when you see this published on Friday. But just for consistency, I'm recording this between the AM and the PM fix. In fact, the pit has just opened because we're only a 4-hour difference. It's at 12:36 AM, 12:36 PM in the UK. And this is where we recorded it last time between the AM and the PM fix. So just to put that into context. And what we're really trying to illustrate here is the structural bullish change in behavior, which is the paper to physical market behavior, that is becoming increasingly difficult for officials to hide. Now, there's insufficient non-sticky open interest. We've talked about that multiple times, which is really, we're just talking about the cash settled speculator held bets, which are dwindling. So there's insufficient of this open interest to target to generate historical sell ignition waterfalls, which we've experienced over multiple years. In fact, these large COMEX short covering footprints into higher prices and declining open interest closely mirror the period the BIS, that was the Bank of International Settlements, moved to square all their remaining asymmetrically imbalanced gold derivative bets ahead of the upcoming Basel III spot FX market compliance on the 1st of January. So they front ran that. Now, much as we see the Fed really doing the same thing, really attempting to step up gold repatriation, really to front run the similar to what the BIS front ran on the 1st of January, obviously. And that culminated in really that a notable capitulative short covering event on the 30th of November at spot $1,616, where they zeroed the last the remaining 500 tons of asymmetrically imbalanced derivative bets, which they'd been holding on to for some 50 years. Now, 2 years on, into the end of the first quarter, and we're just approaching that next week, so we're really recording this on the 19th, so it now costs over $1,400 more depreciating dollars to buy the same ounce, kilo, and ton of gold. Now, Basel III compliance marked the exact inflection point where the European and the global south-facing Bank of International Settlements diverged from the wrong-footed Fed, requiring they needed an additional 2.5 years on the 1st of July 2025 to be able to extricate themselves from their share of really over 50 years of historically accrued, rehypothecated gold leases and swaps.
So in summary, the moment freshly revalued global facing first tier non-stable, NSFR compliant, a net stable funding ratio compliant foreign exchange gold, i.e. real gold. And so the moment it was crossed against the dollar and became T+1 deliverable, 1 day deliverable, it also placed the non-compliant paperback COMEX futures dilutive prices into the crosshairs to be targeted by central bank sovereigns and institutionals. However, the inward-facing siloed paper market was actually granted, and this is where it gets interesting, they granted the Fed an additional 2 years extra time to repatriate sufficient physical bullion to repay billions of mismanaged, rehypothecated Treasury gold IOUs.
Now, while repatriating bullion has been a slow process, under the bid-pull volatility, and we note there's no fresh shorts in excess of what can be offset directly by rinsing naked long speculators, so they do not dare to add any shorts beyond that because they're trying to repatriate. So really, with shrinking open interest, that's becoming more and more difficult. So what we're saying is the paper to physical exchange for physical gap has steadily been closing, picking up significantly. And that was, if you remember, we refer to this is when the Shanghai Futures Exchange launched a physically backed futures trading to citizens on the 1st of March 2024. Guess what this did? It's a futures contract that is physically backed. Now, given the Fed is the only global central bank resisting a higher dollar-denominated gold price, they were exposed as the sole lessee of the gold subsequently borrowed from the Bank of International Settlements to try and contain an orderly repatriation process. However, the reported Bank of International Settlements data makes it impossible to hide that the hundreds of tons of unfactored Chinese buying systematically forced the Fed to continue to repay a series of higher repayments of bullion borrowed much lower in order to try and effect this repatriation. So we fast forward to now. Now, by October, here's October. By the end of October, the BIS here had been caught severely wrong-footed. And basically, that was $800 higher than where they started selling short at 2000 spot. Now, while the Fed was able to bid, but there was enough momentum longs who got on board. And so, again, this is about how many speculators they can rinse out and suck in short. So they were calling a top. It was all the media was talking about a top. And we saw, which was, again, a bid-pulled air pocket, not adding shorts. I want to make it really clear that that's what was going on. But by the end of the year, as the BIS squared, they managed to square it a little bit lower than $800. It was still $600 higher than when they started borrowing this gold from the Bank of International Settlements. So what happened? In short, the Fed misjudged the enormity of this fresh PBOC-sanctioned bullion demand, which survived every single synthetic market attempt to paper down the price as a series of higher global-facing physical supported stair-steps were forged. As these as the price stayed up higher, the physical market caught up. And so by the time you get any dips here, they're immediately supported by, and again, $600 higher than when this whole thing started. And that's why I keep coming back to these 4-hour bar charts. Notwithstanding Indian and Saudi monetary gold demand, relentless Chinese futures buying, physical futures buying, has been accompanied by very large, unreported 400-ounce monetary gold purchases, which by design, one by one, breached buy stops at round number after round number, in turn underpinning physical market supports long enough to set a series of higher stair steps. Now, this PBOC sanctioned gold buying strategy is still in play today. Best estimate is that this strategic central bank accumulation continues into 3,500. And we're talking about within the next 3 quarters. So there, we've gone out on a limb. We'll look at silver in a minute, but essentially a pit close above 34 spot, and this is spot. The futures spread is about 60 cents today. It's been as high as $1.38, but essentially it's getting very risky to short sell silver as US dealers start requesting this bullion back to cover their shorts. But we see little in the way after a pit close of 34 into the 38s. And that's just for starters.
All right, Andrew. Yes, it's helpful to track these higher stair-step footprints on these charts, as it puts the short-term, chart chatter, I guess you would call it, into perspective. Right now, in our last episode, just 2 weeks ago, we looked at the next inflection point that brought into focus the tariff uncertainty. We talked about the Trump tariffs uncertainty and what's happening there. And now we've had a lot of questions in the community about this. And can you update us on how this black swan event is actually playing out now?
Yeah, Shane, it was tariffs, Trump's tariff mandate that really caught the Fed flat-footed. And the sudden race to repatriate paper gold positions into safe haven first-tier gold exposed the inelasticity of the available physical bullion at current prices, meaning there just isn't enough bullion at current prices, meaning that it has to be bought back at higher and higher prices. Now, we previously posted the link and took apart the LBMA video. You remember this video that the LBMA came out? And they were saying, oh, yes, the idea, 8 to 10 week refiner delays for COMEX compliant 100-ounce bars. They're just related to COMEX exchange and, really trying to spin it as, no, there are no real shortages. That backfired. And it drawing really unwanted attention into the real extent of the global supply shortages at current prices. And despite allowable double accounting rules, making the true extent of the supply problems, hiding them, it's been the failure to physically load out the 400-ounce standard bars from the Bank of England LBMA vaults into a Basel III NSFR T+1 delivery protocol. It's that it hasn't moved that's really exposed the true scale of these delivery defaults. Now, we've previously drawn attention to the largely ignored GC, it's called the GC4 Enhanced Delivery Contract. We spent some time looking at it, which enables a local London 400-ounce bar to remain in the London vaults without physically moving to the US vaults, so yet it's counted as there. Now, these flows also synthetically assist in closing the EFP spread, i.e. the spread between the paper price and the physical price. And as an example, we witnessed this into an attempt to block central bank buy stops at spot 3,000 from getting tripped off last Friday the 14th. We knew that Asia would come in and take it, and sure enough, they did. Now, these failures to deliver have not gone unnoticed by competing central banks who have doubled down on targeting and locking in COMEX registered inventory for delivery, alongside locking in exchange for physicals at the AM and PM fixes for Basel III compliant market delivery. So in other words, central banks and sovereigns and the large buyers need a fix. So you might intraday it be higher and lower, but usually it requires an actual fix to mark that to market. So a large size to market. So into all of this maelstrom of bullish inputs, the Fed trying to prioritize 400-ounce bullion repatriations ahead of an upcoming US Treasury gold audit is something that would never have happened had Trump not taken the helm. Now, these repatriation efforts have made it very risky to short sell paper gold into such large physical demand, and it's what has driven the unnaturally widened EFP spreads, the paper spread to paper to physical spread. And in other words, the paper price being so much higher than the physical price. And it was gapping to levels not experienced since the 2020 COVID refinery lockdowns. And the EFP spreads simply represent the higher cost to close out an unbacked paper bet against global facing deliverable gold and silver. And I should add that while the Fed employs agent bullion banks to do the heavy lifting, every single bullion bank, without exception, is actually long bullion for their own books, i.e. they act as an agent. But this is where it gets really interesting. US market Basel III compliance on July the 1st will have as dramatic an effect on the gold price as when the FX gold market was brought into compliance on the 1st of January 2023. So in order to comply, the audit will have to be concluded well before the July compliance date. Now, the realization that hundreds of tons of underpriced paper market positions will have to be marked to a market price where a real seller of a fully owned bar is actually willing to put it on offer. What it does is telegraph much higher true supply-demand prices because they're not going to be paper diluted. And to give an idea of the scale of the next move higher, in line with what we projected when the FX markets became Basel III compliant in January 2023, the minimum next staging point for spot gold to rally was projected at 3,000. Now in sync with what our liquidity providers say, we project it will ultimately cost an extra 3,000 to buy the same ounces of gold, forecasting a minimum of 3,300 gold price by the end of the second quarter. That's very conservative. And a realistic 3,500 by the end of the fourth quarter. Then we're looking at very large moves higher. Now, these are conservative targets. Now, more immediately, and for reference, we're recording this episode on Wednesday the 19th, ahead of FOMC later today. We continue to anticipate a battle at this all-important next higher 3,000 spot gold stair step, currently being established as we get as the next physically supported rally point into the second quarter. Now, if there's any non-sticky long open interest rates, it'll be into FOMC today. And depending on, because we're recording this ahead of that, and you'll have that data, obviously, on Friday when this is published. But if anything, and then you get the end of month stuff that Shane was referring to at the beginning. So yeah, but this is where the support levels now appear to be settling in. So it doesn't matter if the Fed is, whether it's a dovish or a hawkish outcome, probably hawkish. So we may get some volatility into the end of the week, but dips are viewed as healthy, consolidative behavior into fresh physical and ETF buyers reported as coming in from the sidelines in large size.
All right, now, Andrew, you've been drawing attention to gold coming to the attention of a large influx of U.S. funds managers. You've been talking about this. Now, in many cases here, they're not mandated to hold physical gold, so they're buying the COMEX related, exchange traded funds, the ETFs. But unlike the usual speculators who borrow gold from the casino, these U.S. buyers are fully paid up. And they're not able to be rinsed out as easy and as usual at the end of the month here on what you call the wash and rinse cycles. Now, can you update us on the effect of what's happening here?
Yes, Shane, and we're seeing it play out as we speak. As we focus on this really because many technical analysts are still of the opinion that when the published open interest expands, talk about the number of chips in play, which is the casino chips in play, basically, that it provides fuel for the pit managers to basically profitably rig end of month speculators selling waterfalls. What we've been drawing attention to was the published open interest, though, is increasingly strong hands, making that very difficult. And as we looked at last time, with gold outperforming every other asset class, bar none, a rising gold price has not gone unnoticed by fund managers who have never looked at gold investments before. And this massive move into gold has only just begun. This is the point. February alone evidenced an all-time record high of 4.9 billion flow into gold funds alone. And that so far, and that's, we're talking about US funds. And so far, it looks like March is going to exceed that significantly. Now, this gold has to come from somewhere. And with demand competing with Asian investment demand, and that it is bolstered by rising prices, so higher prices gets people more interested in buying more gold, just as it did when gold took off from 2000 when the Shanghai Futures Exchange launched back in March 2024, driving an $800 rally, which really railed against every top caller at the time. Now, with an increasing percentage of futures market bets moving into the hands of funds seeking long-term exposure to gold as an alternative first-year asset class, it's forcing bears to fold bets against gold and driving the 50-year unbacked paper to real physical gold gap to close. And as we know, many funds are not able to hold physical gold, so they buy shares in COMEX-related ETFs and exchange-traded funds. And these bets are seeking exposure to gold. But they're sticky in nature and unable to be rinsed, as you say, into even when they rig synthetically constructed wash and rinse cycles. In fact, quite the opposite. People have figured the game out. The change in behavior is what we're evidencing here and now. And the physical facing market making insiders are aware and taking advantage of this bullish structural change in the composition of historically unbacked futures markets, becoming backed. And the fresh in-house demand is also competing with the Fed, trying to race to buy back underwater leases at market ahead of the July 1st Basel III compliant deadline. And why would it expect more attempts to cap 3,000 gold into large derivative bets being marked to market into options expiry next Wednesday? And first notice comes directly after that. And then the April contract then expires. Now, or these people are going to have to fully fund these positions for delivery on Friday the 28th. Ultimately, there's far too much offsetting a fresh safe haven buying evident at current prices for the cartel to sustain any lasting downside traction. So spot 3,000 has been secured for certainly. We've got 4 fixes now. When I recorded the episodes, there was an AM fix. Now we've had a PM fix above 3,000. So we've got 4 fixes already as of today. So what that's done is actually allow central bank sovereign and institutional buying to be locked in at these fixes And while we don't count out the usual two-way action around a round number, especially when it's starting the next $1,000 milestone. I mean, 3,000 is $1,000 milestone, as was 2,000 being exceeded back in March 2020, a year ago. It's becoming the next physical staging post, as it was back then, a year ago, for the next leg of a physically underpinned rally. There will be little in the way of the next 3,300 staging point. Now, exchange for physical spreads will begin to normalize at the end of the quarter.
All right, Andrew, in our last episode only 2 weeks ago, we looked at in detail at the silver coiling for a very strong rally into the 38s. So what are you seeing here?
Yeah, if you recall, when we recorded our March 5th episode 2 weeks ago, silver was being exposed, it was being capped at, it was $2 lower at $32, where it was pretty obvious that capping at $32 into a strong demand undersupplied global market was going to become way too difficult, as insiders were being forced to short cover so as to accommodate New York dealers actually taking physical delivery to cover their COMEX short exposure. So alongside large backdoor loanouts, this was really forcing the price higher. And now the battle for $34 is there, but once rinsed, liquidity providers are seeing little resistance until the 38s. Now, and that's just short-term stuff. It's not realized that silver will be a major beneficiary of US market Basel III compliance. So liquidity providers see that the cartel's critical upside breakout level is very low hanging, above 34. So they may be closer to 35, but it's low hanging and ready to be triggered. And spot silver is readying to breach massive short stops above that level. A pit close above 34 should trigger large short covering process to begin. Now we're looking for clues for the breakout into the massively expanded exchange for physical spreads. They're starting to contract. That's the clue. It's getting very risky shorting silver into a 4-year and growing supply deficits and very strong Chinese and Indian demand. And while these spreads are volatile, as the fight plays out, narrowing spreads are telegraphing an imminent upside breakout. And while these spreads have been as high as $1.38 per ounce, capping at this level expanded the EFP spreads to as high as 86 cents just this week to try and block 34 from getting filled. But each risky, asymmetrically imbalanced spread will continue to narrow into very strong Asian buying next week, making it very risky to short silver. Also, Bretton Woods OCC stablecoin interpretation is going to force compliance of FX derivative silver and gold. So there is another input which is not yet even being factored in. We'll do something about this next time. But really, just to sum up, with every single liquidity provider and all the bullion banks anticipating it's going to cost way more dollars, pounds, euros, etc., to buy the same ounce of physical gold and silver, the only question I have to end with is how well are you positioned to protect your wealth? This is not about making money. It's about protecting your wealth.
All right. Thank you, Andrew Maguire, for another fantastic episode. And remember, to all our Live from the Vault community members, buy physical, only physical. Understand the difference and a critical difference between what Andrew calls the casino paper gold and silver market and the actual physical gold and silver market. They're not the same. Don't be fooled out there. All right. So there you have it, folks. That's all we've got for you today on another episode of Live from the Vault. But help spreading the word about this channel by hitting that like button. If you haven't already hit the like button, hit the like button there. It really helps the channel. Share this information out and subscribe if you haven't already subscribed. And don't forget, if you want to be notified as each episode goes live, just click on that black bell button right there and we'll do just that. And with that, we'll see you right here next time on Live from the Vault. See you then.